Trump's 2025 tax bill, officially part of the One Big Beautiful Bill Act, passed by Congress on July 3, 2025. This sweeping legislation is set to reshape the tax landscape in the United States, with significant implications for your investments, whether you're a small retail investor, a high-net-worth individual, or managing a business portfolio. In this video, we'll explore the key provisions of this bill, analyze how they could affect various asset classes, and provide actionable insights to help you navigate this new financial reality. This is a big one, so let's get started. Before we dive into the investment implications, let's break down what this bill actually entails. Signed into law by President Donald Trump on July 4, 2025, the One Big Beautiful Bill Act is a massive piece of legislation, over 940 pages long, that extends and expands the 2017 Tax Cuts and Jobs Act, introduces new tax breaks, and includes significant spending provisions. It's been hailed by supporters as a pro-growth, pro-worker package, while critics warn it could balloon the national deficit and disproportionately benefit higher earners. Let's look at the key tax provisions that matter most for investors. First, the bill makes permanent many of the individual and business tax cuts from the 2017 TCJA, which were set to expire at the end of 2025. This includes lower income tax rates across most brackets, a near-doubled standard deduction, and expanded business deductions. Without this extension, 62% of filers would have faced a tax hike in 2026, so this permanence provides long-term certainty for taxpayers and investors alike. Second, it introduces new tax exemptions championed by President Trump during his 2024 campaign, including no federal income tax on tips, overtime pay, and Social Security benefits. These exemptions are temporary, set to expire in 2028, but they could influence consumer spending and certain sectors. Third, the bill boosts the child tax credit from $2,000 to $2,200, with the Senate version slightly scaling back an earlier House proposal of $2,500. It also creates Trump investment accounts, a new tax-advantaged savings vehicle for newborns, with a pilot program offering a $1,000 credit for children born between 2025 and 2028. Finally, there are significant business tax changes, such as permanent 100% bonus depreciation for equipment and machinery, restored R&D expensing, and an enhanced Section 199A pass-through deduction. However, the bill also includes new taxes, like a higher excise tax on university endowments and a controversial revenge tax targeting foreign entities from countries deemed to impose unfair taxes on U.S. firms. Oh, and one more thing. The bill raises the state and local tax deduction cap from $10,000 to $40,000 for 5 years. A big win for residents of high-tax states like New York and California. Now, let's get to the heart of the matter. How do these changes impact your investments? We'll break this down by asset class, starting with stocks. The stock market is often the first place investors look when tax policy changes, and Trump's 2025 tax bill is no exception. The bill's pro-business provisions are designed to stimulate economic growth, which could create a bullish environment for equities. Here's how. Permanent TCJA extension. By making the 2017 tax cuts permanent, businesses benefit from lower corporate tax rates, staying at 21% instead of reverting to 35%, and individual tax cuts that increase disposable income. According to the Tax Foundation, the Senate version of the bill could boost long-run GDP by 1.2%, hours worked by 938,000 jobs, and wages by 0.4%. This economic growth typically supports corporate earnings, driving stock prices higher, especially for large-cap companies in the S&P 500. Business tax breaks. The restoration of 100% bonus depreciation and full R&D expensing is a game-changer for capital-intensive industries like manufacturing, technology, and energy. Companies can immediately deduct the full cost of equipment and R&D investments, reducing their tax liability and freeing up cash for reinvestment. This could be particularly positive for sectors like semiconductors, industrial machinery, and biotech. For example, companies like Intel or Caterpillar could see improved cash flows, potentially boosting their stock valuations. No tax on overtime and tips. The temporary exemption of overtime pay and tips from federal income taxes through 2028 puts more money in the pockets of service and blue-collar workers. This could drive consumer spending, benefiting consumer discretionary stocks like retail giants, e.g. Walmart, Target, and hospitality companies, e.g. Marriott, Starbucks. However, the tax foundation notes that these exemptions could complicate tax compliance and lead to revenue losses, potentially offsetting some economic gains. SALT deduction increase. The quadrupling of the SALT cap to $40,000 benefits high-income households in high-tax states. This could increase disposable income for affluent consumers, supporting luxury goods and real estate stocks in regions like New York, California, and New Jersey. Next, let's talk bonds. The bond market is highly sensitive to tax policy and deficit spending, and Trump's 2025 tax bill has bond investors on edge. Here's why. Deficit concerns. The CBO projects the bill will reduce federal tax revenue by $4.5 trillion over 10 years, only partially offset by $1.2 trillion in spending cuts. This massive deficit increase has raised alarms among bond investors, with some analysts warning of bond vigilantes, investors who sell bonds to protest fiscal irresponsibility, driving up yields. Andrew Brenner from National Alliance Capital Markets noted that recent Treasury sell-offs signal investor unease. Higher yields mean lower bond prices, particularly for long-term treasuries. Interest rate expectations. The bill's pro-growth provisions could spur economic activity, potentially leading to higher inflation. If the Federal Reserve responds by raising interest rates, bond prices could face further pressure. Max Gochman from Franklin Templeton Investment Solutions warned that the bill's economic stimulus might be overshadowed by the negative impact of increased debt issuance. Tax-exempt bonds. The SALT deduction increase to $40,000 reduces the appeal of municipal bonds, which are often attractive to high-income investors in high-tax states seeking tax-exempt income. With a higher SALT cap, fewer investors may need muni bonds for tax savings, potentially dampening demand. Real estate investors, this one's for you. The 2025 tax bill has several provisions that could shake up the real estate market. SALT deduction boost. The increase in the SALT cap to $40,000 is a major win for homeowners in high-tax states. This could boost demand for residential properties in areas like California, New York, and New Jersey, where property taxes are steep. Real estate investment trusts, REITs, focused on residential properties like Avalon Bay Communities, AVB, or Equity Residential EQR, could see increased demand. Mortgage interest and auto loan deductions. The bill makes permanent the TCJA's $750,000 cap on mortgage interest deductions, but adds a new deduction for interest on loans for U.S.-made cars. This could indirectly support housing affordability by increasing disposable income for car buyers, though the impact is likely modest. Opportunity zones and factory incentives. The permanent extension of the Opportunity Zone program, which offers tax incentives for investing in distressed communities, could drive capital into commercial real estate in rural and urban areas. Additionally, full expensing for new factories could spur industrial real estate development, benefiting REITs like Prologis PLD. However, higher interest rates driven by deficit concerns could increase borrowing costs for real estate developers and homebuyers, potentially cooling the market. The Tax Foundation notes that higher marginal tax rates on housing investment under the bill's itemized deduction limits could also reduce capital stock growth in real estate. What about alternative investments like gold, cryptocurrencies, or private equity? Let's explore. Gold and precious metals. Michael Aron from State Street Investment Management noted that gold prices have risen alongside Treasury yields, reflecting investor concerns about deficit spending and potential inflation. Gold could serve as a hedge if the bill's fiscal impact drives inflationary pressures. Cryptocurrencies. The bill doesn't directly address cryptocurrencies, but its pro-growth policies could boost risk appetite, potentially supporting crypto prices. However, the revenge tax and increased scrutiny of foreign entities could create uncertainty for global crypto exchanges or investors in countries flagged by the U.S. Treasury. Private equity and venture capital. The bill's business-friendly provisions, like the enhanced Section 199A pass-through deduction, increased from 20% to 23%, are a boon for private equity and venture capital firms structured as pass-through entities. However, President Trump's proposal to tax carried interest as ordinary income could raise taxes for fund managers, potentially reducing returns. The Tax Policy Center estimates this change would generate $15 billion over a decade. While the 2025 tax bill has pro-growth elements, it's not without risks. The CBO estimates it will add $3.3 trillion to the national debt over 10 years, with some analysts projecting up to $4.5 trillion when including interest costs. This could strain the bond market, increase borrowing costs, and potentially lead to a credit rating downgrade, as Moody's recently signaled. For investors, this means higher volatility in fixed income markets and potential pressure on equities if inflation accelerates. The temporary nature of some provisions like the no tax on tips and overtime exemptions creates uncertainty, as Congress will need to revisit these in 2028. Additionally, the bill's cuts to safety net programs like Medicaid and SNAP could reduce disposable income for low-income households, potentially impacting consumer-driven sectors. On the international front, the revenge tax under Section 899 could deter foreign investment in U.S. assets, as it targets entities from countries with unfair taxes on U.S. firms. This could lower demand for U.S. treasuries, further pushing up yields. That's a wrap on our deep dive into Trump's 2025 tax bill and its impact on your investments. From boosting corporate earnings to raising deficit concerns, this legislation is a game changer for markets. By understanding its provisions and adjusting your portfolio, you can position yourself to thrive in this new environment. What do you think about the bill? Are you adjusting your investments based on these changes? Drop your thoughts in the comments below. I'd love to hear from you.